Imagine waking up one morning, walking to your kitchen, making your coffee, and then picking up your phone to check your balance the way you do every single day, and the app just says, account restricted. No warning. No phone call the night before. No letter. No explanation sitting in your inbox. Just those two words staring back at you. Account restricted. You try to log in on a browser instead, thinking maybe it's a glitch. Same message. You try to use your debit card at the gas station on your way to work. Declined. You call the number on the back of the card and sit on hold for 40 minutes before a representative finally picks up and tells you, in a completely flat and rehearsed voice, that your account has been flagged for review and that the review process can take anywhere from 3 to 30 business days. You ask what triggered it. They tell you they can't share that information. You ask when your money will be accessible. They tell you they can't provide a timeline. You ask if this has ever happened to other customers. They tell you they can't comment on other accounts. And then the line goes quiet, and you realize that every dollar you have, rent money, grocery money, the payment you were supposed to make this morning, is sitting completely unreachable behind a wall that a bank put up without warning, without explanation, and without any clear path to getting it back down. This is not a horror story someone invented on the internet. This is a situation that thousands of Americans find themselves in every single year, and in the overwhelming majority of cases, it was triggered not by fraud, not by criminal activity, not by anything that most reasonable people would ever think twice about. It was triggered by a conversation. Specifically, by something the account holder said to a bank employee, typed into a customer service chat window, or even mentioned over the phone while asking a completely innocent question. Banks in 2026 are operating under compliance frameworks so aggressive, so automated, and so sensitive that certain words, phrases, and disclosures, things that sound completely normal to a human being, can set off a chain of automated flags that result in an account freeze before any human being at that bank ever reviews a single transaction. What makes this genuinely frightening is that the legal framework banks operate under actually requires them to behave this way in many situations. Under the Bank Secrecy Act and a web of related federal anti-money laundering and fraud prevention regulations, banks are not just permitted to freeze accounts when certain red flags appear, they are often legally obligated to. And here's the part that should concern you the most. Banks are also legally prohibited, in many of these situations, from telling you exactly why your account was flagged or that a suspicious activity report was filed. This is called a tipping off prohibition, and it means that if your account gets frozen because of something you said, the bank may be legally prevented from telling you that what you said is the reason. You are left in the dark, your money is inaccessible, and the institution holding your funds cannot, by law, fully explain what happened or why. This is the financial environment Americans are operating in right now. And the three things we're about to discuss are not edge cases or rare situations. They are some of the most common, most ordinary things that people say to their banks every day, without any idea that saying them can set off a chain reaction that leaves them locked out of their own money. The first one involves a phrase that sounds so completely reasonable and so emotionally relatable that almost nobody would ever think it could cause a problem. It goes something like this: I need to send some money to my family member right away. It's urgent. Or a variation of it: my son is in trouble and I need to wire him money immediately. Or my daughter is overseas and she needs funds sent as fast as possible. These sentences, in the context of a bank conversation, are not just a description of a family situation. They are a near-perfect match for the language profile of one of the most aggressively flagged fraud scenarios in the entire banking system right now, which is elder financial exploitation and family emergency wire fraud. Banks have spent years training both their human staff and their automated systems to identify the exact pattern of a customer who is being manipulated into wiring money under the guise of a family emergency. The problem is that the pattern for a scam victim doing this and the pattern for a completely legitimate person genuinely helping a family member look almost identical from the bank's perspective. Urgency. Family member. Wire or fast transfer. These three elements together trigger review protocols at almost every major financial institution in the country. The Consumer Financial Protection Bureau has specifically highlighted these patterns as top indicators of financial exploitation, and banks have responded by training frontline staff to intervene, delay transactions, and in more serious cases escalate to their compliance department, which can result in a temporary or extended account freeze while the situation is reviewed. If you genuinely need to send money to a family member quickly, the way you frame that conversation with your bank matters more than most people realize. You do not need to provide emotional context. You do not need to explain urgency. You do not need to mention that it's for a family emergency or that someone is in trouble. You simply initiate the transfer with the destination details and the amount. The moment the narrative around a transaction starts sounding like someone who is scared and rushing, the bank systems are designed to slow that transaction down, not speed it up. And what starts as a delayed wire can quickly escalate to a flagged account if the back-end compliance system determines that the pattern warrants further review. The second thing that people say to their bank with the best and most honest intentions, that can trigger consequences they never saw coming, involves financial vulnerability. Specifically, it's any version of, "I'm going through a tough time financially," or "I've been struggling to keep up with my bills," or "I'm not sure how I'm going to cover my rent this month." People say these things to bank employees because they're asking for help. Maybe they want to request a fee waiver. Maybe they're calling about an overdraft and they want to explain their situation. Maybe they're asking whether there are any options available to them. The intention is entirely legitimate, and in a fair world, a bank would respond to financial vulnerability with support and flexibility. But here is what actually happens inside many banking systems when this kind of disclosure is made. It gets logged. It gets categorized. And depending on the bank and the specific products you hold, a disclosure of financial difficulty can trigger what's called a risk review. Banks are businesses, and they manage risk at the portfolio level, which means a customer who signals that they may not be able to meet their obligations is, from the bank's internal perspective, a higher risk exposure. A risk review can result in credit lines being reduced without notice, overdraft protection being removed, account types being reclassified, and in some cases, if the bank determines that the account poses enough financial risk, a more extensive review process that temporarily restricts access to funds. None of this is explained to the customer when they make the call. The customer thinks they're asking for help and explaining their situation honestly. What they've actually done, in the bank system, is update their risk profile in a way that may work against them. This is not an accusation that every bank responds this way, and many banks have genuinely helpful hardship programs. But the decision about which response you receive is rarely made by the empathetic person on the phone. It's made by the system their disclosure was entered into. And that system does not respond to emotional context. It responds to keywords, patterns, and risk indicators. The smarter approach, when you need help from your bank during a financially difficult period, is to ask specifically and directly about hardship programs or fee adjustment policies without framing the request around a broader statement of financial struggle. Ask whether your account type qualifies for any fee waivers. Ask whether there are any current promotions or adjustments available for long-standing customers. The outcome may be identical, but the system response to how that conversation is logged can be very different. The third thing is perhaps the most surprising, because it involves something that should theoretically be completely within every account holder's rights. Telling your bank that you intend to take out a large amount of cash or that you're thinking about moving your money to a different institution. People say these things for completely understandable reasons. They're unhappy with service fees. They found a better interest rate somewhere else. They want cash on hand for a major purchase or a home renovation. They want to consolidate accounts. These are normal financial decisions made by adults every single day. What many people don't realize is that under Federal Bank Secrecy Act regulations, banks are required to file currency transaction reports for cash withdrawals of $10,000 or more, and they are also required to file suspicious activity reports if a customer's behavior suggests an attempt to avoid that reporting threshold, for instance, by mentioning a large cash withdrawal in a way that the bank interprets as structuring. Beyond the regulatory threshold issue, when a customer signals intent to move significant funds to a competitor or to withdraw a large portion of their balance, banks can and sometimes do initiate what's called an account review to verify the legitimacy of the intended transaction before processing it. In some cases, this review is completed in hours. In others, it results in a temporary hold that can last several days. There is also a more subtle dynamic at play. When you tell a bank you're considering leaving, some institutions treat that as a retention opportunity. Others treat it as a risk signal. Depending on how your account has behaved historically, a declared intention to withdraw a large amount or close an account can sometimes result in your account being placed in a monitoring status while the bank processes what they may code internally as a high-value liquidation event. It sounds procedural. Feels like a trap. And for someone who needed that money for a time-sensitive purpose, the experience of having a legal withdrawal held up because they mentioned their plans in advance can be both financially damaging and deeply disorienting. The practical guidance here is simple but counterintuitive. Don't announce. If you plan to make a large withdrawal, you don't need to warn the bank in advance during a casual customer service call. If you're planning to move your money to a different bank, you don't need to tell your current bank that you're thinking about it before you've made the decision and taken the action. These are your legal rights as an account holder, and exercising them quietly and decisively is almost always less disruptive than discussing your intentions beforehand. What ties all of this together is something that most Americans have never had to think critically about. The relationship between you and your bank is not a partnership between equals. Your bank has access to your full transaction history, your balance, your behavioral patterns, and a sophisticated set of automated systems designed to identify risk on their terms, not on yours. When you volunteer information to a bank, even honest, innocent, well-intentioned information, you are feeding data into a system that was not designed to protect your interests. It was designed to protect the institution's interests and comply with federal regulations that are far more aggressive than most consumers realize. That does not mean you should be paranoid every time you call your bank. It means you should be informed. It means you should understand that certain conversations, certain words, and certain disclosures carry consequences that no bank employee is likely to warn you about before you say them. It means knowing the difference between what you're legally required to tell your bank and what you're voluntarily offering because you assume transparency would work in your favor. Your money is yours. Your account is your property. But access to that account exists within a framework of rules that most people have never read and that nobody explained when you signed up. The more you understand that framework, the less likely you are to accidentally trigger it. Protect your access. Protect your information. And think twice before any conversation with your bank moves from a transaction into an explanation. That's the information most people find out the hard way, after the freeze has already happened and the damage is already done. Now you have it before. Use it carefully.